Yo, I'm Brendan, and today I'm going to share with you a type of investing fund that on the surface sounds really interesting and cool and appealing because it has some really positive features to it. But when you get into the nitty gritty and you start to really understand why it is the way it is, we find out we shouldn't be investing this way. Regular people like me and you that don't have money to burn on like a chance investment that may work out need to stick to the tried and true investment methods and stay away from this kind of fund. So I'm going to tell you exactly what this kind of fund is, why it seems appealing on the surface, and then why you actually want to stay away from it. Hey, if you're new around here, my name is Brendan, and my wife and I became millionaires last year at 37 years old, and I want to share everything that we've learned about personal finance and money and investing with you so you can do the same thing. On to this mystery fund that I think you should actually avoid, and it's called an interval fund. Have you heard of this before now? I'd never heard of this until recently. So what this is technically it's a closed-end mutual fund, and it doesn't trade on an exchange like the stock market or anything else that we're typically used to as investors, and it only allows investors to redeem their shares to like get money out periodically and in limited quantities. From a 10,000-foot view, what they allow you to do that are unlike other kinds of mutual funds or ETFs is they can own within the fund illiquid investments. For the record, something that's illiquid that could be in this kind of fund is something like private real estate, private equity, like an ownership stake in a company or whatever, commercial properties such as pieces of farmland or forestry, business loans, catastrophe bonds, and real estate securities. They could also invest in collectibles and antiques and certain types of debt instruments and things like that. So these kind of oddball things. And in a normal mutual fund, they're not allowed to put more than 15% of the total assets into that kind of investment. So this interval fund serves a different purpose in that you could put tons of it in there. The origin story of this is kind of interesting because it actually came out the same year that the ETF was created. So when the SEC approved the ETF in 1993, it was also the same year that they approved the initial run of this kind of fund, the interval fund. You might be wondering like me, well then why does it exist? Why can't I just go invest in that illiquid investment? Well, a lot of times there's barriers to entry. How do you know what hedge fund you should go and invest in? What kind of private real estate could you put your money into? What private equity do I have access to right now that I could invest in? All of those things are so ill-defined. And what this does is bring that to the table for you. It also lowers the barrier to entry because if you're going to invest in a hedge fund or something, they're probably not even going to take your phone call unless you've got millions of dollars. But the interval fund adds value to our lives potentially because it allows you to invest without millions of dollars. Some funds do have like minimums, but by and large, it's way less than you would need to get into private real estate or get equity in a company or invest in a hedge fund, those kinds of things. So besides the obvious different flavor of investing, why would people want to access these kinds of investments? What's the deal with illiquid investments? Why is that appealing in comparison to liquid investments like we typically would invest in the stock market? Well, there's a chance that something like an illiquid investment could have a way higher gain than your typical liquid investment. So if I'm investing in an S&P 500 index fund, which I do, I basically will never, ever, ever in my life expect to make more than 25% in a year. That would be a ridiculous year. 2024 seems to be kind of on that trajectory so far. So we're having a ridiculous year. This is party time. But on the average, somewhere between 5 and 10% is probably a lot more realistic as far as a bar to set your expectations to. These interval funds, investing in things like private real estate, private equity, hedge funds, they could potentially go up in value a lot more than that. So if you're hungry for exposure to those kinds of things, this is a way for you to get there. Especially if you believe in the particular interval fund you're looking at because of the way that they do things, it could be really appealing. Everybody likes a bigger gain, right? Everyone wants a bigger return. If I had 30% returns every single year, I'd be retiring in like 5 or 6 years instead of the 15 that we've got left. Okay, somewhere between 11 and 15 by my projections. And if you notice, the other interesting thing about these that's a huge potential upside is the fact that we aren't investing in the same kinds of things that the stock market is. They're not tied together in a direct kind of correlating way. And so let's say that next year in 2025, the stock market has a terrible year. We're down 10%, we're down 15%, something like that. Had you invested in something that doesn't have a kind of correlation in the same business sector as the investments in the stock market that you have, you could balance out your risk then and balance out your returns to say, well, the interval fund is doing 10% plus this year. The stock market things I'm investing in are down 10%, but at least they're kind of balancing each other out that way. It's a way for you to spread out your risk and say, not all my eggs are in one basket. Granted, the stock market is a huge basket. There's a lot of different companies there, but because so much of the basket of the stock market nowadays is tied to really high-tech companies like FANG stocks and things like that, well, if they have a really bad year, we're probably having a really bad year. So on first glance, I really like the potential of having something that's not correlated to the stock market in that way. I've actually been looking for something like that for myself, and I've had some opportunities, if you will, to dive into those kinds of areas because I realize having the bulk of our net worth in our home and in the stock market is a bit of an exposure risk to to us. If I could add in another 20%, say, of our net worth in an area that's not correlated to the stock market, that's still something I really believe in, I think that could be a really huge value add for us. But now it's time to explain exactly why I don't think interval funds are the best way for us to do that, to gain that kind of exposure, to access potentially higher risk. I don't think that they're worth the downsides, essentially. Downside number one is something that I think that you could engineer around. It shouldn't be too terrible, but the fact is it's really annoying and it is still a downside. Just like the name says, it's only allowing you to withdraw funds at certain intervals. Typically what that looks like is the fund itself will repurchase a certain amount of the value of its fund, i.e. it'll give you a chance to sell some of your stuff if you want your money back out of it, every 3, 6, or 12 months, depending on how the fund is structured and what they say in the prospectus statement. So that means if it's a random Tuesday and you want some money out of it because of whatever reason that you need it, you can't do it. You have to wait until one of these time periods, but it gets worse. But the interval name doesn't just come from the time periods that you're allowed to access your money. It's also only allowing a little piece of your money to be withdrawn at any given time. The fund is set up a certain way to where it will only allow between 5% and 25% of your money to be taken out at any given time. And it seems like the norm is a lot closer to that 5%. So here's how it would work. There's a little time window that opens up that says, if you want to take money out, you've got to do it right now. You've got this like 1 to 5 day period, let's say. So you put in a request that says, hello, I've given you a whole bunch of my money. Could I please have some of it back right now? The fund's response to you is essentially, sure, you can have some of your money back, depending on where you fall in line. So as an example, let's say the fund in total has $100 million in assets, $100 million of stuff that people have invested in. If this quarter they open up 5% of that as something they're willing to buy back and give you cash in exchange for that, they're saying the total amount this quarter that can be taken out is $5 million. Not your total, everyone's total. So they have set the cap, the total pool of money that's able to be withdrawn at that moment. And so if you had 100 grand in there and you wanted to pull it all out because maybe the fund is doing really badly and you're sketched out, maybe it's time to buy that new Porsche Carrera T that just came out because it looks really interesting and awesome and you just want that money back. Even if you request to have 100% of your money out, if you're slower to request it than other people who are taking their money out, you're not going to get anything. Maybe one dude has $5 million in there. On the very first day and the very first second that request list opens, he asks for his whole $5 million. Everyone else is out of luck then. You'll have to wait a whole nother quarter or year, however often they open up that interval to have a chance to get your money back out. Another tricky part of interval funds is the fact that those things that you're investing in, those illiquid kind of assets that could be real estate or equity or whatever it is, they are inherently more complex than things that we're more accustomed to in terms of an ETF or a stock or something like that. It's pretty common knowledge that you can dive into some information, figure out if something like a stock or an ETF is overvalued or undervalued. You can look at a company's fundamentals and say, look, they're making a ton of money right now and things are looking good. Maybe I want to invest in that. And because of that whole system, the price of those things is constantly updating. You know, the stock ticker symbol or the ETF symbol is changing all day long because everyone's opinion of what that's worth is being reflected in that price all day. And so it's kind of public knowledge how much everyone thinks something is worth. The opposite is true for these kinds of illiquid assets. How exactly do you value what a stake in this company's private equity is worth, or that hedge fund, or that real estate? Not only is there a potentially huge variation in how someone values that, but there's no public way for that price to continue to be updated over time. How often are they actually assessing the value of that hedge fund? Maybe you get into this thing in 2024 and it's worth $100 billion, whatever this hedge fund is. Then 3 years later, you're thinking maybe you should get out of it. How do you know how much that thing is worth now? How can you verifiably check that and know? I realize those are like big, exorbitant, crazy numbers. I gave an example, but you know, you get the picture here. It's much more difficult to define than something that has a listed stock price. Negative thing number 3 about interval funds is one of my favorites to point out about any kind of investment because it's so blatantly obvious how much this just kills your return and it kills your potential to grow your net worth over time. That's high fees. Because these things are high touch, they're high intensity, they are actively managed, that immediately means we're going to expect high fees. From the research I've done, the average management fee for an interval fund is 1.38%, which is pretty dang high. The average for a mutual fund is only 0.55%. And that's just the one fee. So then if you take all of the associated fees that affect the fund, that are all net, removing a chunk of your gain, the all-in average interval fund costs 3.25%. And in comparison, the average mutual fund is 0.96%. So that means to just compete with the stock market, apples to apples, no other changes. It's going to need to make 2.5%, 3% more than the stock market every single year to be able to add value to your life. Otherwise, it's just sucking you dry. And part of this high cost downside thing that they don't talk about any of the research that I've done, but I feel like there's opportunity there for this to exist, is extra kind of hidden fees along the way. I don't know how much they are allowed or not allowed to legally disclose every single fee that could be involved in these kinds of things. But when we invest in the stock market, it's a pretty straightforward thing. There's a management fee or not. There's an expense fee or not. Those fees by and large are very, very known to us. The scary thing for me about something like private real estate or private equity or something like that is how else is there a structure within the structure? It's not as simple as buying a security. What if the same company that's offering this fund who's collecting a management fee from you also is somehow collecting a fee to manage the real estate or to do the accounting or to do some other aspect of what this looks like for this business to exist that's not obviously disclosed? Well, they're still making money on that. And how can you verify that? How can you dig in and fact check that? It's just, there's too many layers between you and the actual asset to really investigate that thoroughly. Maybe I'm totally wrong there, but I just feel like the potential is there to get even more hosed. Another fee in association with these funds that to me is a complete deal breaker in and of itself, besides every other thing we've talked about. This one thing for me is a deal breaker, and they're called redemption fees. They're also known as repurchase fees. These can be upwards of 2%, and that's whenever you're actually taking money out of the fee. Whenever they're repurchasing your investment, they're giving you cash back, you're giving them a chunk of your investment back, they're going to charge you another 2%? Are you kidding me right now? So you're paying potentially 3% every year plus 2% whenever you want to take money out? I see all the upside for the people running the fund and not a whole lot of upside for us investing in the fund. Now, just as an example of this kind of fund, I wanted to share this with you because I wanted to actually look at the website for one of these kinds of private equity, interval funds and see, what do I see if I'm someone who's investigating this? What kind of positives am I going to look at, and how easy is it to see things like the fees? By no means am I trying to pick on Carlyle or this particular tactical private credit fund. This isn't any vendetta against anybody in particular. It was just one that was easy for me to find. So it says their goal is to provide access to a wide array of private credit strategies to meet its goal of delivering current income. So it's not like it's trying to appreciate in a bunch of value. It's trying to generate income. And to do that, it's going to invest at least 80% of its assets in private fixed income securities and credit instruments. So it's investing in other financial instruments. That includes liquid credit, private credit, and real assets credit. So if I'm reading this right, they have $4,566 million under current asset management. And so I read that it's $4.5 billion in management. Their distribution rate seems really attractive at over 10%, which I'm assuming that's essentially like an annual dividend yield, if I'm understanding this correctly. Here's a bit more information about the distribution rate. So that represents income, capital gains, and return of capital, if any, in the reporting period they've given. So I'm going to take that as sort of a total gain, if you will, not just a dividend payment. 767 different holdings. That seems pretty diverse. And they are leveraged a bit, 18.6% leverage. You can see that's their level of debt and preferred equity as a percentage of total assets under management. Looks like year to date, they've had a 9.15% return. Their 3-year return is 7.7%. And here's what they're actually investing in. In terms of where they are in the world, 80% of it is in North America. Another 20% is in South America, Europe, and Australia. And then here's the kind of specific financial instruments that they're using to get this return. Opportunistic credit, which I have no idea what that is, structured credit, real assets credit, direct lending, liquid credit, and special situations. That sounds like that could be literally anything. So it sounds like they're providing financial services to software companies mostly, banking and finance and real estate, healthcare, consumer services, and then a bunch of other ones, as you can see here on this list. Then in the prospectus statement, I just did a quick Control F to find the word fees. And right above that, I see an investor will pay a sales load of up to 3% on Class A shares and 3.5% on Class L shares. Oh boy. Well, needless to say, I'm not going to read the entire 109-page prospectus document for you, but I think it's like what I expected to see, which is on the surface of things, it seems interesting. It seems potentially appealing. Diversify your investments. Get a 10% return, 4.5 billion other dollars are in there, so why not mine? But the reading that I've done to dig a little deeper tells me that this is a disqualifier for me. Let me know if you're still interested. If you're already investing in an interval fund, be interested to know that too. But by and large, I wanted to share this with you just so you can kind of have your spidey sense up and open and go, maybe we'll stick to more traditional things. Maybe you want to diversify. By all means, do your thing, but I think there's a big cost to it. So just know that going into it. Here's another very interesting video for you to watch next. And thank you so much for watching, everybody. I'll see you later. Bye.